Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Allied REIT Properties is the worst performer on the TSX today. It's off more than 20, almost 27% right now. The real estate company reporting a wider than expected loss in its latest quarter of just over $1 billion, driven by a sharp increase in losses on investment properties. The quarter was also affected by an expected credit loss on loans. In addition, rental revenue also fell 4% compared to the year before. Allied says it is executing a plan to strengthen its balance sheet and improve financial flexibility. Shares of Alimentation Couche-Tard are moving higher today. They're up about 3.7% right now after the gas station and convenience store giant unveiled its full-year targets. Couche-Tard plans to focus on strengthening its core platforms with an emphasis on investment opportunities. The move is projected to drive profit growth of 10% through 2030 and same-store revenue expansion of up to 3%. The company also expects free cash flow of more than $2.5 billion. Gibson Energy is buying Chauvin infrastructure assets for $400 million. The deal includes the purchase of a crude oil pipeline and related infrastructure assets that connect Chauvin to the Hardisty oil hub in Alberta. The acquisition will enhance Gibson's heavy crude oil network by extending reach to new and established producers. The energy company also announced a $200 million equity offering. And taking a look at the markets right now, the TSX has turned around after a green start to the day, but it's off by about 0.42%, still above 33,000 right now. And south of the border, you can see a mixed bag there. Also, after a strong start, the S&P 500 up ever so slightly, pretty much a wash, but the Dow and the Nasdaq have spun the other way and are off in the mid-morning right now. While Shopify shares are under pressure after the e-commerce platform missed profit expectations in its latest quarter. On the upside, revenue was better than expected. We got more on the company's results with C.T. Panagrahi, Managing Director at Mizuho Securities.
They beat across the board. Its GMV was 31% versus expectation was around 28%. But also, if you look at merchandise, merchant solution revenue, that was up 35% versus expectation was 32. So it was a pretty strong quarter across the board. But also the guidance was strong too. They guided also above expectation. That was another reason you can see a strong beat as well as guide. So revenue low 30% versus expectation was mid 20%.
Now, Shop Pay gross merchandise volume was up more than 60%. But I mean, I'm not a huge internet shopper, but I don't recall seeing Shop Pay as an option. But maybe I just haven't been on the right sites.
Yes. So what Shopify is trying to do is for the merchants, they're offering different channels for them to sell to different consumers. So, and Shop Pay, payment is one of the key driver for merchant solution growth. Whether you have your own website or you're trying to sell it at, whether at the Google search or social commerce, they're everywhere as a checkout button. Yes, I mean, you have not seen that, but probably you are not shopping at one of the Shopify merchants. But yeah, that is one of their key strategic, goal at this point.
Shopify stock, maybe we'll put up a 5-year chart, is down from its highs. Why are investors more cautious these days than they were more than a year ago, for example?
Yeah, I mean, if you see last few years post-COVID, stock came down because, in fact, their growth decelerated. But last few years, since post-COVID, if you look at the GMV growth has been accelerating from 19% to, last year, 24%, and 2025 was 29%. They are trying to re-accelerate their growth. But lately, what you have seen is that AI disruption. That has been right now key concern across software, and investor looking at Shopify as another software platform for merchants. I think that is why at this point you see stock underperforming.
Actually, sorry, the stock actually peaked more recently in late October at about 249 Canadian. So it was pretty recent, the peak. Do you feel those fears, those AI disrupting software fears, are overdone?
I think so. I mean, there is a little bit of, I think it's overblown, but the way investors look at first is, they try to penalize everyone in overall software, then they'll try to handpick, like look at individual companies. So Shopify, they think it's a software platform, but effectively, if you see, this is the execution platform for any e-commerce vendor right now, any merchant. So it is not a software that you can do vibe coding. They own the mission critical execution layer at this point. And the other point is agentic commerce. That's the new trend that's coming in, and they're investing heavily there. If you think that's the next future, from social commerce to search commerce to now agentic commerce, they're well positioned there. So time will tell, but I think, yes, at this point, the fear is a little bit overblown.
And agentic is where the AI just acts as a sales or really a customer assistance person. It's not a person, but it'll help answer my needs. It won't just address questions like it's talking to everybody.
Yeah, so you think of that's from a consumer perspective for you and I. But for a merchant, if you think that's the future, a merchant wants that channel. They want to capture that channel. If you're in the Google search, they want to be seen. If you're at the TikTok, they want to be seen there. Now, if you think you and I are going to go to ChatGPT for our shopping, a merchant wants to be there so that you buy their products. And what Shopify does, it helps those merchants. They help enable that agentic commerce as a channel. So whether or not we'll see how the adoption will take off, whether you and I will use an agent to buy goods online, but at least this enables those merchants, Shopify enables them to be available at that ChatGPT or Claude.
And he was speaking with Siti Panigrahi, Managing Director at Mizuho Securities. Coming up, Stingray's CEO Eric Boyko joins us to talk about Q3 results, agreement with BYD, and why in-car entertainment may be the next frontier. Montreal-based Stingray, a leader in audio, video streaming and distribution, just announced its Q3 results. The stock is up nearly 20% over the past month, but down today about 5%, a little more than 5%. The competition in the space is heating up. Can its recent acquisition and new agreement with Chinese EV giant BYD help it stay ahead? Let's unpack all that with Eric Boyko, President, Co-founder, and CEO of Stingray. Eric, thanks very much for joining us as always.
Thank you for the invite.
The market's not excited, it looks like, about the earnings today. What do you think has them worried?
Oh, I think, the stock moved up like 40% in the last 2-3 months. So normal people are adjusting. And what we're most excited is to see what the analysts are going to report the next few days. Our first analyst came up and increased our rating from 18 to 21. So very happy with that increase.
And with these numbers, say organic growth, just taking a look at it, 8.5% for broadcast and recurring commercial music. Is that sustainable, do you think?
With the TuneIn acquisition, I think the organic growth for this year will be well above 20%. The TuneIn acquisition will increase our sales by 40% to 640 million. Our EBITDA will increase by 50% from 160 to around 240. And our free cash flow will grow up by 60%. So it's been a super acquisition for us.
What's giving you the confidence about TuneIn, and what does it bring to you?
The big advantage of TuneIn is we have a lot of inventory on the Fast TV. We have a lot of inventory in retail media, unsold inventory. And TuneIn is an ad stack selling machine. And they're already able to, right now, our sales synergies in the first month alone is 16 million of run rate. So I think we'll be achieving a lot of positive sales synergies.
And where do you hope to see that number go from there, the 16 million?
Oh, I think it's unlimited. A year programmatic sales, when computers trade and it's instantly done, we were doing 0 a year ago. And now we're going to be doing $500,000 US a day. So you put that over a year, it's 182 million US, 250 million. You don't see many businesses going from 0 to 250 million in 1 year.
Now, any concerns about any margin dilution from the growth, like the Singing Machine and the Fast initiatives? I'm fascinated by the Fast. Is it not just TV, essentially?
Yes. The fast channels, when you think about it, you've got 70 to 75 billion of ad sales that were done on the linear channels, NBC, ABC, the good old, and that is moving to the fast channels. It's also moving to Amazon. It's also moving to YouTube. But our goal is to get as much share of that inventory and to be able to monetize it.
And where do you see with the dilution? Any concerns with that?
Yeah, I think our margin is at 35% EBITDA margin, but we'll slowly go back to the 40% EBITDA margin we're used to. But this year for us, with this acquisition, like I said, it was a perfect wedding. We're very excited. And don't forget, the last quarter we only had 9 days of TuneIn. And so this quarter, Q4, will be the first quarter where we'll be able to show the market all of the proof in the pudding.
All right, and I want to talk a little bit more about your agreement with the Chinese EV giant BYD. What does that mean, and how do you see yourself fitting in with that and with other manufacturers? Yeah,
we came back from CES, the big show in Vegas. We must have met over 60 OEMs. Stella, the president. Sorry about that. The president of
you're a busy man.
The president of BYD was there in person. Sorry, I thought I put my phone off, but it was alarming. We had 60 deals with all the car manufacturers in play right now. It's ours to lose. We are very excited, and I think the TuneIn and Stingray, we were both competing for that space, and now we merged together. So we're really in a unique position to win all these cars. Don't forget, we launched BYD, Mercedes. We've also just announced Nissan, GM, and a lot more coming. So we're very excited to be in every car in the world over the next few years.
And what will that be bringing to the vehicle and for the driver?
So think about it. It's going to be in your car. You're not going to have AM, FM radio. You're going to have TuneIn for the radio. Your channels are not going to be XM Sirius. They're going to be Stingray Musics. You're going to be doing karaoke. I know parents are unhappy about that, but every car will have karaoke. And all that will be built in every car. And we will be sharing advertising revenues from the listenership, just like we do on traditional radio.
And is this open to all markets then? Does this open you to all markets in the world?
Yeah. Well, one of the few companies that we are a global company. So that's where the car manufacturers want to deal with us. If you look at our friends at XM and iHeart, they're mostly focused on the US. We're able to do global deals. So that's why every Chinese car manufacturer, European and American, will be using Stingray.
And you had two or three acquisitions in the last quarter. I'm trying to remember. Do you see more acquisitions? Do you see more buybacks? What do you intend to do with some of the cash?
No, there is so much. Right now our debt EBITDA after closing this deal is still below 2.5, but we expect to be below 2 by December in the next 3 quarters. So we're very happy about that. And then again, we'll see where our capital allocation is. And the TuneIn acquisition, there is so much positive sales synergies. I told people that we we killed an elephant, but in this case, I think we killed a mammoth. We have a lot of meat, a lot of stuff to do over the next 12 months. So I think we're going to be focused on this deal and the positive synergies and the integration.
Okay, Eric, thank you very much for joining us today. We appreciate it.
And sorry about my phone. It was my brother calling me.
Okay, no worries. Family's important. Eric, thank you very much for joining us. Eric Poyko is president, co-founder, and CEO of Stingray. Coming up, Kraft and Heinz pause their split as the company looks to reinvest in its U.S. business. Our next guest will break it all down for you. Kraft Heinz says it is pausing its split, which was originally planned for September of this year. The $46 billion merger, masterminded by Warren Buffett, made Kraft Heinz one of the largest food companies in the world. However, the merger has not gone as planned, with the company now forecasting a weaker than expected 2026. To break this all down, we're joined by Arun Sundaram, Senior Vice President of Equity Research at CFRA. Arun, thank you very much for joining us.
Yeah, thanks for having me.
Initial reaction to the numbers, which ones stand out? Which ones cause for concern?
Yeah, no, it was a disappointing quarter to end a quite disappointing year for Kraft Heinz, but that's not a major surprise. This is a company that's been sort of struggling for really the past, I would say, like 5 or 6 years. It's been a challenging environment for Kraft Heinz. Even over the last 4 years, the company hasn't grown volume sales, and a lot of that has to do with the fact that a lot of these packaged food companies, Kraft Heinz included, have been raising prices over the last several years. But pricing is not given; it's earned. And I think a lot of these center store packaged food companies are learning that a lot of the price increases that they've taken over the last few years are somewhat unjustified. And so 2026 is likely going to be a big reinvestment year for Kraft Heinz. They're likely going to lower prices, invest more in marketing and R&D, things like that. And while that should yield better results, it's probably not going to come immediate. So 2026 is expected to be a big down year. But the goal right now is that 2027 should look a lot brighter. But that's a long ways out. So we'll see if that really happens.
And was there one side or the other that took a bigger hit in this, or is it just kind of all across the board?
Yeah, really, right now there's. I mean, a year ago it was really a lot of their legacy grocery brands were struggling, think like Capri Sun, Jell-O, brands like that, Oscar Mayer. But now we're starting to see some weakness across more brands, even some of their historically faster growing brands. Like its condiments business used to be much faster growing. It still is, but there's a little bit of a deceleration there. And I think that's largely why the company decided to pause the planned split or spinoff. Mm-hmm. It's because they're seeing some weakness spread across more of their portfolio. It's not just their legacy grocery brands anymore. It's a bigger piece. And so now the plan is to really revive growth of the entire portfolio before they consider, another spinoff or something like that.
And I mean, the new CEO just came in for January 1st. It really didn't waste any time on this decision. It must say something.
Yeah, that was a little surprising because Steve, he came on January 1st. He actually came from Kellogg, which actually spun off into Kellanova. And so when Kraft Heinz announced that he was joining the company, everyone thought, oh, this is the person that will lead Kraft Heinz through the spinoff. He's done it before. He's here just for the planned separation. And then now it's just a little bit over a month and they've called it off. I think what's not a coincidence is that a few weeks ago, Berkshire Hathaway, their largest shareholder, put this filing in that they could potentially sell their entire stake of Kraft Heinz. And they own about, I think, like 28% of Kraft Heinz. So that probably added to some pressure here and maybe caused the company to, be like, hey, maybe we want to pull back or pause on this separation because they don't want to angry their largest shareholder because it's a tough sell to investors when your largest shareholder exits the company and you're trying to tell all the other investors that, hey, we're planning to split into two separate companies. Believe in us when, obviously your largest shareholder, which is not just any shareholder, it's Berkshire Hathaway and Warren Buffett, and they're, making the run out the door.
So is Callahan, do you think, is he the one who can bring these two together, or is he just trying to clean it up and then set it up for another split again?
Yeah, that's the big question. Right now, the talk is, or the rationale is that it's just a pause. They're not canceling the spinoff. They're pausing it right now. The goal is to get back to profitable growth. That's not going to happen in 2026. Maybe 2027 they'll get back to profitable growth, and at that time maybe they'll reconsider a spinoff or a split. But that's a long ways out. A lot can happen between now and towards the end of 2027. So we'll see if they really do go forward with the split. Because, like I said, they probably do want to get the backing of their largest shareholder right now, which is Berkshire Hathaway, and they haven't been. Berkshire Hathaway hasn't been particularly pleased with the spin or the separation.
And I mean, it's quite the challenge too when you've got losses across the board. Where do you start?
Yeah, no, exactly. Like if you looking at the results right now, and they've been declining organic sales for the past few years. On top of that, they've been experiencing some significant margin pressure. Kraft Heinz actually used to historically have some of the strongest operating margins throughout the entire packaged food space, but that's been deteriorating over the last several years. So they haven't been able to grow sales. Their margins are coming down. Earnings have been coming down. The 2026 forecast was well below consensus expectations. And part of that is because they've announced this $600 million investment in 2026. So they're doing things like investing in lowering prices, increasing marketing expenses, increasing R&D, and all that will have a near-term impact to margins. You don't typically see those investments pay off immediately, so it takes a while, and that's why 2026 is expected to be a pretty sizable down year. We're now looking to look at the dividend actually, because if you look at where their earnings are forecasted for 2026, their dividend payout ratio is around like 75 to 85%. That's quite high for a packaged food company. You typically want to be around 50 to 60%. So if this earnings weakness does linger into 2027, which we don't foresee right now, but if that does linger into 2027, then there's going to be bigger questions of whether this dividend will be cut. And it was cut in the past before too. In 2019, Kraft Heinz cut their dividend by over 30%, and they've really been struggling ever since that dividend cut in 2019.
Okay, some challenges ahead then, Arun. Thank you very much for joining us.
Thank you for having me.
Arun Sundaram is Senior Vice President of Equity Research at CFRA Research. Coming up after the break, we'll break down Shopify's latest results as the company beat on revenue in its Q4, but missed on profit. We'll get investor perspective when we come back. Bloomberg News is reporting U.S. President Donald Trump is privately considering exiting the North American Free Trade Pact. According to the report, Trump has asked his aides why he should not withdraw. U.S. Trade Representative Jamieson Greer says the administration would hold separate talks with Mexico and Canada. Canada-U.S.-Mexico trade agreement is set for a mandatory review before a possible extension. It starts on July 1st. Shares of Finning International are trading lower, down about 2.45, almost 2.5%, let's say. The industrial equipment dealer posted revenue for its latest quarter that beat estimates, but reported profit that came in below expectations. Revenue for used equipment also fell 23% compared to the year before, and sales for equipment rentals fell short. Despite this, Finning says its mining, power, and energy markets remain robust. They expect markets for construction equipment to improve in 2026. We'll be talking more about that in about 10 minutes. Shares of Bombardier are up after the jetmaker won a 40-plane contract for its Challenger 3500 aircraft from private jet firm Vista. The order is worth more than $1 billion and will see Bombardier delivering aircraft for the next decade. The deal comes after recent comments by U.S. President Donald Trump, who threatened to impose 50% tariffs on Canadian aircraft and decertification as well. Looking at the markets, and a turnaround from the start of the day. The TSX is off by about a half point at 33,100, almost even. And south of the border, you can see everybody is in the red right now. Various levels of it, though. The S&P 500 off ever so slightly, pretty much a wash. Dow a 0.2. The NASDAQ down by about 0.4%. Shopify has reported revenue for the fourth quarter that beat the average analyst estimate, but profit was a miss. For more on the tech company's earnings, we were joined earlier by John Zechner, chair and founder of J. Zechner Associates.
In this environment, everybody's been very worried about software stocks in general. I wouldn't necessarily call Shopify, a SaaS provider like some of the other ones that have been under pressure, but certainly, an e-commerce facilitator. And they'd been growing revenue in sort of the low 20s throughout the pandemic, and then into the mid to high 20s. And I think getting over that 30% bar is going to put a lot of worries at ease for now. It's interesting too. We saw a couple of upgrades in the past 2 days before the numbers released, and saw always brave for analysts to upgrade in front of an earnings number. So I guess there was some confidence out there. So, there's probably a little short covering this morning. I mean, that the move we're seeing in the pre-market will be good for probably 100 points on the index overall. So it'll give a lift to the Canadian market. But it's a great story. They continue to grow, and that's a fantastic number. They're facilitating mid and small businesses access to the to cloud services, to effectively to retail, and they're really sort of migrating as well as any software company the use of AI into the knowledge of their customer base and using that to improve the sales and profitability. I mean, if there's any negative that might hold it back a little bit is costs continue to rise. The margins, the free cash flow margins, from what I've seen, and the overall margins are probably coming down a little bit, which is it's just the cost of doing business. It's just sort of as you grow, you have to sort of put more money into this, and they've been through a pretty big capex spending phase. I think they're starting to realize that they do have a lot of free cash flow, and so initiating the buyback is the other tailwind for the stock this morning.
Now, what do you think of the comments from the president, Harley Finkelstein? 2025 with Shopify at full throttle, driving compounding growth while laying the rails for the new era of AI commerce. Will this restore some confidence with tech that AI is going in the direction everybody is hoping it would go?
Well, I think it's a real sort of pick and choose, Roger, there, because it's going to go from company to company. We're going to have to see a lot more reports of similar commentary and similar growth profiles too, because we know the market right now is paying for revenues. You saw that with the hyperscaler reports, where you have the positive aftermarket reaction from Meta, and the negatives on Amazon and Microsoft. So you've got to start driving all this spending into revenue growth through the AI channels, but they can implement it better. I mean, Shopify, this helps their customers know their own customers better, and if they can get a higher level of sales, they get more specification, they regions knowledge of what the customers are buying. That just improves their productivity, improves their overall sales. So that it's just, if they can incorporate that, it's fantastic. I think the worry is more in the markets is some of these bigger application software companies, the embedded systems, the old license, SaaS providers with packaged software, are they going to be they're sort of seeing their growth slow down dramatically and their prices come down and the number of seats they're using decrease because, AI will start to, take some of that business away from them. So that is the bigger question. I still have my doubts. I think, they've got too many worries about it. People, you're not going to suddenly have AI do your taxes instead of Intuit. There's a lot of these things you're not going to shift over. I'm not going to have ADP, I'm not going to have AI do my payroll instead of ADP, so it'll take a while, but I think Shopify is in a better position, to migrate over to the use of AI, implement it, and get greater productivity from it. And that's what the market wants to see.
Now, all those companies that will probably implement AI. Is there the danger, though, that we could hit a point where AI can't do any more for us when it comes to industries like Shopify? Like when you know everything about your customer, how much more can you know?
Well, that's a good question, Roger. I mean, at this point, there's also the privacy side of that same argument. People get a little more defensive about that. Are you going to start blocking the access to this so they can't see and they can't follow? So, that is going to be an issue going forward. For now, it just helps them target their marketing so much better, which is why you've seen, online advertising, have success in the past couple of years. Why, Meta and Alphabet have gained so much ground, on their cloud services and what they're providing to their customers, because they can target more effectively. So I think there's still a long way to go, but there are other concerns, and it's not unlimited, the gains. But yeah, at some point, what are the ultimate benefits? Can you increase the benefits? And then the bigger question is, do then they continue to spend on the capex side to the same degree we've seen? Because that is, that's the big tailwind lifting the entire economy and the market, is this, a crazy level of spending like that we're seeing. I mean, obviously what we saw from Amazon and Alphabet in particular just raised the bar substantially.
And that was John Zechner, chair and founder of J. Zechner Associates. Well, coming up, we're breaking down the latest results from Finning International and Toromont. We'll have the details right after the break. Finning International, the world's largest Caterpillar dealer, just posted modest revenue growth and a record high backlog, but its competitor, Toromont Industries, delivered an even stronger beat. What lies ahead for these two companies and which is the better play for your portfolio? Well, let's find out. We're being joined now by Maxime Sychev, Managing Director, Industrial Products, National Bank Capital Markets. Maxime, thank you very much for joining us.
Thank you, Roger.
Okay, which one do you like more when you putting them side by side? How do they stack up?
Listen, I mean, it was a very solid quarter for both companies. If you look at the share price performance for both over the last 12 months, I mean, pretty impressive for both. I would say that when you have to incrementally commit capital right now, my preference would be with Toromont, despite its higher P multiple. And the reason for that is just greater visibility of hyperscalers' CapEx commitments in the U.S., and that is being manifested through Toromont's AVL subsidiary, which right now represents roughly 7% of top line. But we estimate somewhere in the 10 to 15% of EBITDA and growing extremely rapidly. I mean, revenue was up 20% Q on Q in this asset. And when you look at the likes of Alphabet and Amazon committing hundreds of billions of dollars to CapEx and growing by 60% year on year in 2026, I just find the trajectory or forecastability of earnings dynamic slightly more exciting when it comes to Toromont, even though absolutely not taking anything away from the Finning's management team, which has been performing admirably.
And what has Toromont been doing better, or is it just little? Is it small things, or is there one thing that they've outshone Finning?
Yeah, to be honest, again, it's just the exposure to the end markets which are showing the most exciting level of growth. And I mean, obviously, right now, AI and data center CapEx explosion is really something that investors are very excited about. And I mean, like, I don't have to tell you, like, if you look at the software stocks and how they've been performing over the last couple of months, so anything which is in the firing line of negative AI gets sold. Anything which is benefiting from AI and data center space is benefiting dramatically. You see this in Caterpillar share price performance and the valuation. I mean, Caterpillar is trading at the highest multiple going back to 2007 at 32 times PE. And that, by definition, is dragging up absolutely the entire cohort, whether it's on backup power, turbines, et cetera. And again, that dynamic is slightly better represented with Toromont, even though Finning does do power systems projects in the UK and Ireland. And there's actually an emerging opportunity right now in Alberta. So we're hopeful that some of that stuff will come to fruition.
I was going to ask you that on the call. That was brought up, and they hinted at something, but they didn't get into a lot of details. But it's obviously a focus and an opportunity for both of them.
Yeah, absolutely. It's just the bulk of data center commitments in the U.S., just because, again, like, it's such a large cluster of companies and less issues with delivering power versus what we would have seen historically in Canada. Another dynamic is just scale. It's, if you're, Facebook or Amazon, when you're thinking about these gigantic facilities that needs to be, ramped up, in terms of committing your capital and resources and time, it's easier to add something to existing clusters versus contemplating sort of a brand new geography. But, absolutely, there is some stuff percolating in Alberta, and I'm sure we're going to see one or two announcements in a not too distant future. But nevertheless, the bulk of data center growth does reside in the U.S. That being said, I think what's critical for both names to understand on a relative basis, copper is the biggest driver when it comes to share price performance, when it comes to Finning. And I mean, copper right now is in a very, very healthy backdrop right now, and I mean, and Chile is a significant driver for Finning, and Argentina potential could be coming back. So there is definitely very positive percolations of growth when it comes to Finning. Eastern Canada is a little bit more predictable when it comes to transit spending, and we're talking about $100 billion Alto high-speed opportunity in the east. That could be a very large opportunity for Toromont. So again, both companies are benefiting from both better outlook on infrastructure, mining, and data center spending as we speak.
And what about potential headwinds for the year?
Yeah, headwinds. I would say that anytime you talk about commodities, these things are never easy to forecast. And that's the reason why we prefer Toromont in terms of predictability, because for the fitting stock to work, you have to get two things right. You need to get the oil price right, because I mean that's a big beta for the Canadian business, and copper. Obviously, if somebody's thesis is that copper is going to $10 a pound, you're going to get a very different response. But we have seen that whenever copper pricing moderates, capex moderates accordingly. So that's where the risk-reward dynamic between the two makes me shift our preference in Toromont vis-a-vis Finning.
All right, we'll have to wrap it up there, but Maxim, thank you very much for joining us.
My pleasure.
Maxim Sytchev is Managing Director, Industrial Products, National Bank Capital Markets. Up next, we'll break down the latest data from the U.S. jobs front. That's after the break. CTV's Adrian Gabriel now with a reaction from businesses that could be affected by the opening of the Gordie Howe Bridge between Windsor and Detroit being blocked by U.S. President Donald Trump.
Spanning 2.5 kilometers across the Detroit River, a long-promised economic driver could be forced to take a detour.
We're home to the busiest commercial border crossing between the U.S. and Canada. This is insanity.
While President Donald Trump's political speed bump threatens to derail the planned opening of the commercial corridor, some industry leaders see an opening to accelerate negotiations.
As of a few weeks ago, conversations weren't happening between U.S. and Canada. They were stalled.
Nicole Vlanich, the executive director of the Canadian Association of Mold Makers, says the U.S. president's bluster doesn't surprise her, even though Trump has previously supported the project. This joint statement, released by President Trump and then Prime Minister Justin Trudeau in February 2017, says that we look forward to the expeditious completion of the Gordie Howe International Bridge, which will serve as a vital economic link between our two countries.
It's right. I mean, it is vital. I think we need the second bridge. It's been talked about for over 20 years, why it's needed.
Political leaders in Windsor and Michigan say they're united by a common goal.
This bridge will open. It's fully constructed.
It is important that it continues to move forward and open up on time.
What would any delay to opening this bridge mean for your industry and the industries here in Windsor, Ontario?
When we think about job growth and job potential on both sides of the border, it would delay that.
The bridge is expected to increase the current $1 billion per day in trade that flows through the Windsor-Essex region, while creating a smoother commercial alternative to the Ambassador Bridge.
If there's an issue with one bridge, they can go to the other. It'll stop the traffic delays.
With negotiations now reopened, the hope of many here is that a clearer path will be paved for future economic growth. Some local business leaders here, as well as politicians, believe the Gordie Howe Bridge is simply being used as leverage by President Donald Trump as he pushes to negotiate a wider America First agenda. Adrian Gabriel, CTV News, Windsor, Ontario.
The U.S. economy added 130,000 jobs in January, while unemployment fell to 4.3%. For more on this, we sat down with Andy Goldberg, head of U.S. rate strategy at TD Securities.
The job numbers themselves were certainly quite strong. We had some upside surprises, definitely not enough negatives to go around. But that drop in the unemployment rate to 4.3, which is roughly the Fed's estimate of NAIRU, the basically kind of the steady unemployment rate, that's going to give people pause. That's going to really tell the Fed they're not in a huge rush. They don't necessarily have to go in the very short term.
That's interesting. I mean, it's only 1 month. Is there any indication as to why U.S. employers are feeling optimistic and they're hiring?
Well, if you dig down into the jobs data itself, we did see some pretty serious gains in healthcare and education. And that's been a category that's been driving a lot of the job gains. This time around, it drove more than 70 or 80% of the total increase in employment on a month-to-month basis. So the sectors are definitely more concentrated. It's not really a broad-based recovery. And as you mentioned, this is 1 month. I think what it does is really take the heat off the Fed to go necessarily at the March meeting. But they're going to keep watching. This is not over yet. They know that the labor market is going to be quite jumpy on a month-to-month basis. What they really look at are trends. They tend to look at 3-month trends, 6-month trends. This is just one data point to them. But I think for markets, this really helps the markets lower the pricing for March and potentially even April rate cut pricing.
Maybe we could put up a one-year chart for the US dollar. Now, we did see US bond yields rising, people selling bonds today. They often do that when they see borrowing costs stay stable. And I know the Fed doesn't influence bond yields directly, but it looks like this is causing ripples in the longer-term debt market.
Yeah, and what this really does is kind of influence the very front end of the curve. We did see a sell-off. It was actually a curve flattening. So the front end actually sold off more than the long end. For me, this is just a function of the market pushing off the first rate cut, modestly increasing the Fed's terminal rate pricing. So, for example, where they expect the Fed to really end the cutting cycle, that's gone down into the low 3s before this print, and it's popped up a little bit after that. So what this really means to me is a little bit more patience for the Fed, not necessarily, a Fed in a rush to cut interest rates. And it really complicates the job for, incoming Fed Chair Warsh as well, who's, has been appointed with the promise of additional rate cuts.
That's interesting. Sorry, what does it mean for Kevin Warsh? Give us that again.
Yeah, what it means is Kevin Warsh is going to really have a bit of an uphill battle, potentially convincing the rest of the committee that additional rate cuts are necessary. We've seen in the last month or two, the committee just become much more cautious as we get closer to their estimates of where neutral is. They see neutral somewhere in the range of about 275 to basically 375, with the core of the committee somewhere between 3 and 3.25. Now, as we get closer to that, the debates just get more and more intense. Kevin Warsh is going to have to go really out of his way to convince the rest of the committee that they must cut rates immediately, that they must cut rates rather quickly. It's going to be tough for him to convince the committee if you continue to see labor markets behaving the way they are and inflation the way it is. Something's going to have to change. So I don't think by any means anything is over. We're going to keep watching every single month payroll numbers. But for now, at least, I think it's a bit of an all clear for the Fed to stay on hold.
Would you be a buyer of US 10-year bonds right now? Say your horizon was 5 years and you were looking for a capital gain. I mean, in other words, do you see the US 10-year yield coming down or going up over the next 5 years? I know it's a very simplistic question.
No, that's and it's actually a really great one. What we've seen recently is a big rise in the term premium. So this is kind of the estimated premium that an investor gets for holding longer dated interest rates.
Gennady, kind of a risk premium.
Exactly. Right, it's a bit of a risk premium. So effectively, I think this is actually quite attractive at the moment. For 10-year Treasury yields, that premium, according to the New York Fed's ACM model, is about 80 basis points. I think over a longer horizon, that's actually quite attractive for investors. I think around 410 to 430 on 10-year rates is an attractive entry level for the longer term. I think for investors who are worried about the short term, and I think that's what's keeping a lot of folks away, there is a little bit of worry that we can shop around in that range, or potentially, yields could move a little bit higher short term. But I think for the next couple of years at least, these are going to be fairly attractive points to enter. The issue is, again, investors are worried about some of the short-term risks to economic data, the Fed independence, and all sorts of things.
Just finally, there was a revision to the U.S. job numbers, apparently, and it showed a slowdown in hiring for the prior year. Do you attach much weight? The numbers were too optimistic, it sounds like, or too high. Do you attach much importance to that?
The statistical folks actually do some surveying on really investor expectations for the revisions. The revisions were just marginally larger than expected. There are annual revisions every single year. Mm-hmm. What this tells us is really what we already know. The labor market wasn't quite as strong over the last year as people thought. We already thought it was weak. This just kind of gives us a better sense of just how weak it was. I don't really attach much meaning to that for the go forward. I think it's extremely interesting to see on kind of a backward-looking basis. But what matters on a go forward rate is firm sentiment around hiring, generally hiring expectations, and really what happens in the last couple of months. And that's why I think the Fed is looking at 3 and 6 month moving averages of payroll gains and the unemployment rate for a clearer read on the economy.
All right, Gennady Goldberg, head of U.S. rate strategy at TD Securities. Joining us today on Market Call is Chris Blumas. He'll be on the show. He's portfolio manager at Raymond James Investment Counsel. He'll be taking your questions on North American large caps. And Know Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. And let's just take a quick look at the markets and see how things are unfolding there. You can see the TSX is off by 0.43 right now percent and dragging that down a couple of key names. Shopify off by more than 11%. This, I think, is a bit of a mix on some of its earnings and then also just that general fear about AI in that sector, in the tech sector. It's taking a hit today. Allied Properties as well off by closing in on 30% after their earnings report, and also down Terravest Industries as well, off by quite a bit. Down south of the border, it's a mix. You can see S&P 500 and the Dow Jones pretty much a wash right now. They're in the green, but not by much, and the NASDAQ is down by 0.36%. Thanks for watching Morning Markets. We'll see you back here tomorrow.